Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome again to the Greedy Trader channel. Awesome. Well, I'm going to be doing today lesson 7. So for those of you who've been following the professional trader mentorship program, I'm really good to see you guys progressing. I'm sure the last lesson was very packed and informative. I doubt some of you have even finished it, and if you've managed to get through it, I would seriously suggest you go over it again and make sure that you understand everything that has been taught. Obviously this lesson is going to be a little bit more interesting, I think, because I'm going to move away from some of the initial chart stuff we did on the stocks side of the program, because in the next lesson we'll be moving into Forex. So it's a good point, I think, at this stage to talk about risk management, which is what we're going to talk about. Now, you are going to see that I'm going to give you an understanding about risk management from a point of view that you've never heard, or you probably, even if you've heard it, you haven't heard it articulated well enough for people to understand. Because again, I'm only saying this because having been in the business for such a long time, and I've worked with traders before, and especially newer traders, and one of the things that I always see is an ability to manage risk. Right? It manifests in various different ways, like people saying that I FOMO'd into something or I overtraded, and you know, the reality of it is that if you had a system that required you to take 200 trades a day, I mean, who am I to object to that? But if you had a system that told you to take 200 trades a day that you didn't risk manage properly, then I can easily see how you're going to blow out. So I think the importance here was to be able to reflect on this and say, this is how you really risk manage. And these are the things you need to think about before you start, you know, developing strategies around risk. And my experience is that I don't see enough traders who are doing this, and that's primarily the reason why I have had to include this in this section of the course. And I've done it very early. I feel I haven't done it too late, I haven't done it too early, because I think there's always the risk of trying to teach people about investing but then running straight to risk, right? Because it's the most fearful thing. You know, you're going to lose all your money. That's what everyone keeps telling you. So it's the thing that people are most nervous about, and as a consequence, a lot of the educators out there feel that they need to deal with this topic very quickly so they can go on and do the fun stuff, which is the technical analysis, which everyone is pretty much crazy about. But in my opinion, you can't really do technical analysis really well if you don't understand risk management really well. In fact, I can argue that you pretty much don't need to understand technical analysis if you understand risk management. Most of the time, you are going to take these trades and ignore a lot of technical signals anyway. So the bottom line is, risk management is the singular most important thing in your journey as an investor. And to be able to understand it, and at least understand how professionals think about it, I think is really crucial. So we're going to cover that for sure. Now, one of the things I'm going to ask you guys to do is I'm going to ask you to share this program. It is a free program. It is here on YouTube. It's completely free, and I need you guys to share that. Because again, if other people don't know, the algorithm doesn't know, we can't expand this knowledge. I'm doing this pretty much out of charity at this stage, right? So again, like I said, it's not for me. I've always said this through the lessons. It is not for me. It is for you. So if I'm taking the time to do this, then I think you should hit that like button. You should subscribe. You should share it so that, one, it helps the YouTube algorithm. Secondly, a lot more traders like you who are struggling on forums. I mean, you just have to go on Reddit So you guys share it on your platforms that you go to. I know most of the people who are going to be watching this are going to be, for the most part, most people are going to be under 40, right? And that means that a lot of you guys are still pretty young and you use social media a lot. I mean, share it on your TikTok, share it on your Instagram. There is absolutely nothing wrong with this. And the reason why I'm doing this is because I want to be able to show people that, look, this is not difficult. Like, in order to do this, you don't need to be like super, super smart. You don't need to have worked with Shashka Khan or some other investment firm. You don't need to do any of that, right? You just need to be able to understand what the business is about fully. Now, there's so many people charging tons and tons of money, lots of it on, so some of you, it will just shock you. I mean, there are trading programs going for 10,000. It doesn't make any sense, right? Considering the failure rate, it doesn't make any sense. So I wanted to be able to, one, teach people properly, and I'll do it for free. And all I ask in return is gratitude, and that's through sharing. And I'll do it, and I'm going to give you insurmountable proof. One of the first things I did in the introduction program was to show you proof that I am profitable over a sustained period of time. And that obviously means that you can now walk away. Like I said to everyone, I really don't care if you think that, I know a guy who does 1,200% annually. It's not sustainable. I already know that, so it's not even an argument point for me. I don't really care who you know, who's traded what, blah, 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 or, what program you saw online, blah, blah, blah. The reality of it, most people won't give you the knowledge I'm giving you now for free. Impossible, right? I'm yet to find that individual who is doing that. I haven't seen that on the internet, right? Most people do have paid programs, they do have things, so it's not giving you this depth of information for free. It's technically nuts, right? Someone with my knowledge and experience over 15 years in this business, it is just nuts. You're not going to see it. Everyone's doing it for money. And I think we're reaching a point in human history, evolution, whatever you want to call it, where people need that help. I mean, we're going to enter very desperate times. I think we are, for those of you who perhaps are thinking, blimey, another conspiracy theorist, whatever. I mean, I urge you to read The Fourth Turning by Neil Howe, who's a very, very, this is a New York bestseller. It is by all means a mainstream book. And I do urge you to read that. If you haven't read it, it's going to be instrumental as well as you consider your financial journey, asset allocation in the future, maybe your retirement, things that you pass on to your kids. You need to think about the times we're living in. And I think a lot of people in power, politicians, presidents, prime ministers are aware that we're going through the most pivotal point in human history. The decisions we make are going to shape a generation. Right? And I think people are going to struggle. This is a winter, as Anthony Robbins would say, right? It's a winter. We're going through an immense winter, and there are people in the world who are recognizing that, and I'm one of them. So this is just part of my contribution so that we can all make it through this winter into brighter times for those of us who are still young enough to do that. So it's important that you pay attention, guys, but also you share this knowledge with everyone. You will only get back tenfold. Anyway, let's dive into the program. Enough about you sharing, right? But you should share this for sure. Right. So we're going to start with the story of risk, right? So I call it the story of risk, but really what I'm trying to sort of highlight and bring to the table is what makes an investment risky and how we should perceive that overall, right? So let's start with leverage, right? Because leverage is a key component of increasing risk on the table. So leverage is the amount of money you can borrow against a cash deposit. So once you start to hear words like borrow, lend, it means that you have the potential to go into debt, right? And that's why leverage is such a determinant, in my opinion, of risk. So say for example, let's make it practical. Okay, so say for example, you have a leverage of 1:400. That essentially means that for every dollar deposit you make with a broker, that broker is willing to lend you $400. So essentially give you exposure to an additional $400. So leverage is definitely a form of risk. And because we are going to be heading largely into talking about Forex and commodities, these are leverage markets, right? So the risk on these are much higher. The gains can be a lot higher, But let's be realistic. As we get through this lesson, you're going to see why some asset classes are going to offer you better opportunities than others from a realistic standpoint. But leverage markets carry the most risk. And because I'm going to be talking about Forex in the next lesson, it felt I wouldn't be justified to do that if I didn't talk to you about leverage. Right, so leverage is key to making as much money as possible, but it can also destroy you completely, and you have to be aware of that. And we're going to also talk about other concepts down the line, like deleveraging and stuff like that, but I'm not going to jump the gun. Right, so the other aspect to risk is margin. So margin is kind of, in a way, these two interplay off each other, margin and leverage. So margin essentially is the cash deposit you need to pay. Now, bearing in mind, your leverage ratio kind of dictates the margin you have to put down. This is true for any financial asset, whether you're buying a house or, you know, if someone says to you, you've got to pay a deposit and then I'll give you exposure to some cash, like say, for example, in the case of a mortgage, which is the most common example, then you have a leverage position in the housing market. Basically, it is a leverage position. Now, of course, you're making a commitment to pay down that debt, right? And in some cases, if the house appreciates, you can essentially offset the debt. But still, it doesn't remove the fact that you now have an immense risk on that housing trade. And if you see what happened in 2008, for example, you can see how bad that trade went for a lot of people as well. So again, if the leverage in the system was better managed, for example, then that crisis wouldn't have occurred in the magnitude that it did. But most people were leveraged, from financial institutions to the average householder and as a homeowner, as they like to say. As a result, it was a problem, basically, in a nutshell. So leverage kind of dictates the amount of deposit you need to put down. So the higher the leverage, the lower the margin requirement, in other words, right? So margin is a cash deposit you need to enter a trade, essentially. So for example, let's say you have $20,000 worth of shares, you know, so that essentially required you, say, let's say a $2,000 deposit to get exposure to that amount of shares. Essentially, that means you have a 10% margin requirement. So what it's basically saying that, look, if I want to own $20,000 worth of shares, all I need is $2,000, right, to be able to do it. Now, bearing in mind, you don't have $20,000, right, which is technically the value of those shares. You've put $2,000. So think about it, guys. How quickly are you going to lose that $2,000 if the entire $20,000 portfolio value drops to $18,000? You're broke. You're gone. Right? And that is not a big drop. Right? So having a 10% margin requirement is actually really small. If you're an equity trader, for example, that's a really small margin requirement. And believe it or not, guys, there are brokers out there offering these really, really low margins, attracting people with $200, $100 with the hope that they're going to turn that into $1 million. Well, obviously losing $200 is nothing, but some people think bigger. So they might come in with 50,000 and then start to employ a 10% margin. I mean, think about it. You put a 50,000 deposit, you got access to $500,000, right, in share value. So if you're not using that carefully, you're going to lose all your $50,000 very, very quickly. In pretty much the same fashion, you could easily lose $2,000. So understanding the risk is amplified whenever there's leverage on the table, and lower margins are not necessarily always exciting. They're only exciting if you understand that, well, if I'm putting a small deposit, then I might be able to make, I might be able to increase that deposit by 50, 60, 70%, 100% even. But when you start talking about increasing that $2,000 deposit to, 50, 100,000, then now we're talking a completely different ball game. So it tells me as an investor that you're taking risk that is not sustainable in the long term. So I think it's important to kind of get that out of the way very early, so everyone knows what my position is on leverage and margin. So for the guys out there who are obviously swinging for the fences and posting P&Ls on, you name it, that's great for them, right? That is definitely great for them. But personally speaking, I would not advise any investor to take that pathway. And guys, just so you know, there are so many influencers out there who make a lot of money if you do courses and programs with them. So it's in their interest to show you large P&Ls. It's to show you risky behavior. It's in their interest to even risk their own money and look at it like a one-time event. So that if I can take this $20,000 that mum gave me or my college fund and I can get this to even 60, that's 3 times, then I'm going to get a lot of students that are going to compensate for this. So it's worth it to build a social media following based on extreme risk behavior. But that's not how investing works. And if you take that path, as sure as you're listening to this program, you're going to lose all your money. Right, so let's talk about now risk. Now, essentially the components of risk. So we have what we call systemic risk, right? So systemic risk is essentially an entire system melts down, right? So I think we have to start understanding that exposure to the market means that there's some things you can't control, and one of the things you can't control is systemic risk. And we saw that in 2008. For example, the Euro-Swiss crisis. These are all, well, no, not quite the Euro-Swiss crisis, but 2008, World War II. These will be considered pretty much systemic risks, right? So again, we want to be clear on what the systemic risks are in the system. So take, for example, now there's a high risk of systemic issues. We are not really in hot wars, but we are in a couple of hot wars in Middle East and in Eastern Europe, and these hot wars can easily blow over and create massive systemic risk, right? And that's going to have either a negative impact, it's going to have a positive impact. A good example was COVID, which was a systemic risk. Pandemics are always systemic risks. If you weren't paying attention for this, then you wouldn't have been in a position to benefit from it, for example, because when COVID happened, most people thought the entire stock market was going to melt down, even though prices did plummet, but they actually appreciated more than they plummeted within a short space of time. So again, in systemic risks, you tend to want to buy the bottom. This was true in, with the story with the banking family. I think is it the Rothschild? It is the Rothschilds, I believe, who obviously profited from the bond market. When we had the Battle of Waterloo, where Wellington obviously defeated Napoleon. So that's a good example of that kind of systemic risk where people tend to buy the bottom because that's what you do, in other words, right? So that outcome, because it was the outcome of a war, there was always hope on the horizon that, the whole situation is going to get better. So systemic risk can have both a negative or positive impact. So you have to kind of be aware of the times you're living in and the sort of systemic risk you could face, right? And then you got market risk. So market risk is obviously a specific risk internal to a specific market or group of markets, for example. So take the Euro-Swiss crisis. So that was isolated to European assets, largely the Euro and the Swiss. So there we got market risk from the fact that the Euro was pegged to the Swiss franc, right? And essentially what that meant was when that peg was decoupled, right? So in other words, the Swiss franc versus the Euro was being manipulated. That's the easiest way to look at it. Is peg is kind of that. Is that we're going to agree that the currency is not going to go below a certain level. So you end up with this currency that trades relatively flat, and the floor, I believe, was 120, right? So the Euro will fluctuate around the Swiss at about 120, which was 120 Swiss franc to the Euro. So that was the floor, right? So if ever it went under the floor, then that's a problem, and it's the agreement says that this is a peg, so we can't really go under that level. So that's a classic case of manipulation, which increases the market risk, because what most professionals would have done was assess the possibility of the Euro or the Swiss central bank changing policy, right? There's always that risk, right? When you're dealing with a peg, it's not forever. They could change policy. Another good example is how Donald Trump felt about China and its kind of pseudo peg around the US dollar, which is the case for most of the BRICS countries. And obviously, in the case of China, there was this talk of like, it's not fair to peg yourself to the US dollar because it doesn't give the US an advantage, blah, blah, blah. Anyway, had the US changed policy or got China to change policy, then that could have affected the Chinese yuan. So again, just being aware is really important of the potential for a market risk to develop within a market that you are operating in. Counterparty risk. Well, this is the big one, right? So there have been quite a few high profile broker failures. I mean, we discussed that when we talked about brokers. So brokers are one form of counterparty risk, but also in some markets, the counterparty risk is higher because the players in that market are rather unstable, or essentially they're just not, from time to time, they have a history of not fulfilling their obligations, right? So it increases the risk that you have is, you know, in the market because of that counterparty risk, right? So that kind of exists. So we always have to be aware as well of counterparty risk, that there could be a credit event or something that is going to render a counterparty insolvent. In 2008 was partly that as well, where the counterparty risk increased as people made more money. And that's another thing, guys. Markets are always going to try and restrict you from making money, because if as a retail investor or as a group of retail investors, whether you're institutional or you are an individual, now if let's say certain assets, there's an event and an asset does 200-300x, right? Most of the time there's a counterparty has to lose the exact money you made, right? So, or a collection of counterparties have to lose that money. Now, in some cases, those counterparties are directly against you, in which case the risk is even higher. But where it's an exchange, you often find that the counterparties or the intermediaries that help you access that exchange are often finding a pseudo way or backdoor way to be against you, right? So they tend to almost always be on the opposite side of your trade. Now, again, if you don't believe me, I would say the first thing you want to check out is the Commitment of Traders report. I actually have a video on this YouTube channel, and this is something I'm going to do as we get to the end of the course, is I'm going to do individual videos on individual subjects that relate to this course that I can't cover in the main course because it will make it too long. So I'm going to do those as fragmented videos, which should hopefully help build your knowledge. So if you don't know anything about the Commitment of Traders report, then it's perfectly fine. I have a video on that. However, if you do already know, I would seriously suggest that you go search the COT report, look at how counterparties position against each other. So you'll often see commercials or like big firms, or normally referred to as commercial entities or hedgers. They're going to be in one direction, right? So let's say they're long or they're buying an asset. And then you're going to see someone is going to be on the opposite side of that trade. So sometimes it's dealers or intermediaries like banks, depending on the asset. Sometimes it is large retail speculators that are going to be on the other side of that trade. So what you essentially see is that there's someone always taking the opposite side of that trade. So what do you think happens, right? What do you think happens if one of these counterparties makes an immense amount of money than the others? At some point, one side is going to have to call in their losses and the other side is going to have to book their profits, right? And when that happens, you get an almost immediate reversal of each person's position, right? And that can bring in extreme amounts of volatility into the market, right? So there's always a consciousness with market makers, is that they don't want to be too extreme, right? So they don't want to be in a position where they're losing too much and then their counterparty is making too much, right? So there's always going to be that drive where, as I like to say, they're going to want to shake you out of that position just so that you're, if anything, you should be the losing party, right? Not them. So the reality is that the bigger the players, the more they have the ability to shake you out. And that's just a fact of life. So anyone who's probably saying, oh, it's a conspiracy theory, there's no one controlling the market. I'm not saying there are people controlling the market. What I'm saying is that there are people who are going to use various nefarious tactics to ensure that you lose money. And that includes your intermediaries that help you, so your brokers, other counterparties that are associated with those brokers. And once again, if you don't believe me, I just need to cite the very public incident with Robinhood and its clients, for example, and nothing against Robinhood, but it's obviously public knowledge. It's out there that obviously this did happen, right? So this is just something that you need to be aware of. And if you don't know anything about the Robinhood story, I suggest you go to Google and see what the situation was, so you can start to build a picture that this part of risk is really serious. So essentially we have to more or less sort of factor all of these things in. The what's the point, effectively? What is the point of managing risk, right? So when we do that, we're looking at a couple of things. So I'm going to list the 3 things that I think are the things that we need to come to grips with when we talk about risk management. So the point here is that we want to make more than you lose, right? That goes without saying. If you are managing any kind of risk, you effectively want to be able to make more than you lose, right? That's basic principle, right? So if you're not doing that, then that's already a problem to start with, right? So there's something wrong. You're clearly violating something in the risk management model that you need to bring to the forefront. The other aspect of it is being able to understand volatility. Now, it is absolutely shocking to me, right? And I'm not going to color code it. It's absolutely shocking that people don't know that some assets are more volatile than others, right? And they're volatile in the short term, right? So if you're trading stocks, for example, since a lot of this module is centered around stocks, you need to know that the velocity of your risk is going to increase. So in other words, you're going to lose money a lot quicker if you're dealing with an asset that is highly volatile for whatever reason, right? So you've got to manage your risk accordingly. So let's take an asset like Coinbase, right? Now, let's say you wanted to go short Coinbase, right? And again, like I said, for me, shorting is not one of those things I'll advocate for new investors. But let's just so we can get this point around risk. Let's say you were shorting Coinbase. And Coinbase did the reversal it did the other day. I think in the space of a couple of days, Coinbase went from about $80 to $140. I think it's somewhere about $140 now. Right, now think about this, guys. Right, how much money you've nearly lost twice the money that you have, right? So let's say you were short for $2,000, right? Value that short. You're now in the hole for negative $2,000, right? Because it's almost reversed double. So imagine Coinbase. Now, I can't say this enough. So imagine Coinbase goes to $300 a share, $400 a share, which was its IPO level. You're finished. You're gone. You not only don't have the money to get out of that position, you owe your broker. It's a really bad financial position, right? And you're probably going to go away and you're going to go online and say, oh, the market cheated me, blah, blah, blah. But the truth is that you didn't understand that Coinbase is a really volatile asset. Now, on the flip side, think about Apple. Right, Apple's pretty stable. It's not increasingly volatile. I think the IV is about 20% on Apple versus, say, Coinbase, where the IB is double that amount. I think the IB is close to 50-60%. Right. So, understanding volatility, but by IV I mean implied volatility, and we'll talk about this when we get to options because I think it's a little bit more relevant as we talk about option derivatives. But for now, don't worry if you don't fully understand what implied volatility is. There's always Google, but if you don't worry, we are going to cover it, right? But it's important to know what the volatility is, right? And if you know the volatility of your asset, it will help you manage that risk better. So you know that, for example, maybe it's not a good idea to short Coinbase because it can do radical things. Or if you're going to, you might want to have a pretty close and tight stop loss, for example, and we all do know that stop losses might not get filled, in the sense that in the stock market, if the stock gaps up, then you get filled at the pretty much the worst price. So being aware of this, I'm not saying you shouldn't trade Coinbase, but you just need to be aware as part of your risk management model. So again, Apple, like I said, is a much lighter asset to trade. Again, do not overtrade or over leverage, right? So we're just talking about leverage. I'm hoping at this point in the program, you fully understand what leverage is. And if you don't, just go back a couple of slides and read over what leverage is. Look, guys, overtrading will kill you. Bottom line. Because there's not that many opportunities to trade in a day, right? I don't care if you're the best scalper in the world, blah, blah, blah. There's just not, arguably there are opportunities all the time, right? And you know, the faster you are, the more opportunities you can get. But most traders are not technologically fast or massively technologically savvy. Yes, you could build an algorithm that can do X, Y, and Z, but the truth is that most traders just want to trade old school, right? Otherwise, I mean, most of the people watching this program, you know, they don't have some secret bot that's making them millions. It doesn't really work that way. So most people just want to trade, and they want to be able to do it in a sensible way. So you don't really want to be over trading, right? You only want to trade grade A opportunities, right? So you want to risk your money on things that are worth trading, right? You don't want to be taking grade B, grade C, got a hunch kind of type trades, right? You want to take the ones that are sure fire. For guys who follow me on my Discord channel, for example, they know what I'm talking about. Sure fire. Everything you see me put on, it's got a 90% probability of either going higher, or in the case of some of the options that I sell, premiums, and we'll talk about that later on. You know, I'm expecting a complete crash, and they're going to expire worthless, right? So I'm looking only for the grade A setups, because again, that means you trade less for one, and you save a lot on commissions. I mean, it's just important that you look for the grade A stuff. And of course, you don't want to over leverage, right? Because essentially deleveraging is really important. And we're going to talk a little bit more about that. But the more you increase that leverage, the more your risk is to your capital on the table, right? The chances you're going to lose your money are quite high. So whenever you see a broker say, I got 1 to 1,000 leverage, I mean, what you should be thinking to yourself is, shit, how fast can I lose my money in this situation? Not like, oh, great, that's amazing. So it means I can trade with less and make more money that way. I mean, that's like the proper. I don't even want to insult a lot of the retail a lot of the retail traders out there that are pretty good. I don't want to insult them, because most of these guys are much better than even people I've seen in that call themselves institutional traders, right? A lot of these guys, you know, in the retail space are amazing, and they make some really good returns, some good money for themselves. So I don't want to insult the entire retail trader crowd, but you know, if you're excited about massive leverage, then you're just stupid. There's no other way to put it. You know, and you're soon going to find out why that is not the way to go. And again, like I said, I'm not really wanting to insult anybody. It's just the facts that you need to redress your thinking if you're thinking that it's great to have tons and tons of leverage. So the other side I want us to jump into, and maybe after this section we're going to take a bit of a coffee break, and then we'll come back to this, right? But the other section I wanted to talk about is the probability of ruin matrix. I like to call it the matrix, right? Now, if you don't understand the matrix, then you don't have any business trading, right? I can tell you that now. If you were a trader for 10 years or 5 years or 6 years and you don't know what this is, you're looking at my screen and you're thinking, what the hell is this? Then stop trading now. Just literally stop now, put everything down, and just go back to basics, right? If you've been trading for a year, 6 months, and you haven't been taught this, then you're lucky, because I'm about to save you a lot of time and energy. Now, the matrix is essentially a chart that tells you how much risk reward you should have versus how much probability of win versus loss you should have in order to avoid blowing your account, right? So it's called the probability of ruin, because on a certain quadrant of this matrix, you are 100% going to lose all your money. And that's the quadrant we want to avoid. So we're going to talk about this more from a practical point of view. So most traders are going to fall somewhere in this quadrant. So for those of you guys who've seen my own P&L in the beginning, the introduction part, obviously my own curve, I can safely tell you that I'm more down the middle side of this quadrant, right? So I'm trying to more or less get myself to push myself more to this end of the quadrant, right? Because this is, and we're going to talk about this, right? So this is kind of where I want to be. So I want to be in the bottom left of that quadrant. It's not very easy to achieve, but it is achievable, right? And we're going to talk about some of the ways we do that. And some of the things I've showed you already are geared towards pushing you into this bottom side of the quadrant. Now, traditional attitudes towards speculation, trading, investing push a lot of traders to this side of the quadrant, right? And even the more fantastical, like the guys who post on Twitter, are pushing you to the bottom right of the quadrant, which is not even realistic. It's like nigh enough impossible. If you're on this side of the quadrant, then you've got some insider information. You know, someone's feeding you some stuff. Most people, right, the vast majority of people are going to be on this side of the quadrant. And we're going to talk about that. And then there is a few people through persistence that are going to land on this side of the quadrant. And for me, this side of the quadrant is the toughest side to be on, because this is the sell, I call it the sell the dream side of the quadrant, right? The 4-to-1, 5-to-1 trades that you get 30 to 40% of the time. And if you don't believe me, just go to Google and see what some of the educators will tell you, that, oh, I only 30% of my trades are right, and I make X amount because my trades are like 4-to-1, blah, blah, blah. You hear this all the time, right? And in fact, some people have claimed they make 12-to-1 risk reward, 100-to-1 risk reward, right? So what I normally attribute this to is the asset, right? So maybe they're trading an asset that's highly volatile, like Bitcoin. So a lot of early Bitcoiners achieved 1500x return. I mean, if you were an early investor, we're talking, 2 million% return. So yeah, in those scenarios where you're dealing with where you're dealing with a low float asset, and you're dealing with something that's new and it's very, very cheap with a lot of upside, then landing on this side of the quadrant, maybe trading that singular asset, is possible, right? No diversified strategy will put you on this side of the quadrant, right? It's not going to happen. Or you're trading maybe a low float stock, so maybe you're shorting stocks, for example, and these things are crashing out. You're hitting shorts day by day, and you just basically, it's a broken slot machine, right? So basically, the slot machine's not working, so you're milking it. It's broken. You're just literally pulling coins out. So maybe in those circumstances, you're going to find yourself here, or in very extreme cases, you're going to find yourself here, right? Because the slot machine is broken. And usually it's in these kind of spaces you'll have scams, right? So a good example is crypto scams. Crypto scams sell investors the idea that they are going to effectively be on this side of the quadrant, right? Or they will sell them more believable scams that say that they're going to be on this side of the quadrant. So for me, crypto scams and stuff like that tend to be in this region of the quadrant, right? Where they're selling the dream, telling you can achieve this, or literally someone is rigging the game, right? So then you start to see gains like that. And I'm sure a lot of you already, when you go on social media, you see a lot of people advertising this side of the quadrant. Now, the funny thing is that most people end up dropping to this side of the quadrant. And how easy is it for you to be there? So let's look at it from a practical standpoint. Now, let's say you're a trader that can achieve a 30% win ratio, right? And you're trading a regular market, let's say the S&P 500 for index traders, or you're trading a Forex market. You're getting 30% of your trades right. You're achieving a 2-to-1 risk reward. There is a 100% probability that you're going to blow your account if you continue with this track record. Now, for a lot of you, you're going to be stunned. You're going to be like, what? I double my money on every trade? You mean I actually make double? What am I saying double? I actually make 200% return on every trade, and I get 30% of them right, and I still lose all my money? Shyster. Right? Now you can actually see the same occurrence, right? That if 35% of your trades are right, and you get a 2-to-1, there's 100%, you get a 1-to-1, sorry, there's 100% chance you're going to blow your account. Right? Now, if we push that to 2-to-1, then that drops drastically, right? So it's a really fine line. We're talking about a 5% variation between blowing your account and then staying solvent. So a lot of people might just hit that variation, right? Which this is what keeps the hope alive. They might just get that extra 5% this year and they don't blow their account. So it just starts to justify that it's possible to achieve a 30% 2-to-1 and still not blow your account. So it brings that false expectation that all I need to do is get a few trades right and I need to make my risk management better by doing multiple X's of my risk or multiple R's, right? This is not entirely true. We're just looking at the variation, that 5% variation, which could go either way between complete ruin and no ruin, right? Or a small chance of ruin, under 1%, right? And as you can see that with things like commissions, spreads, they can easily take this 2-to-1 to 1.5-to-1, and then all of this looks red again, right? There's 100% chance. And if we think about the 1-to-1, even if 50% of your trades are right, which is a coin toss, and you were achieving 100% return on those trades based on your risk, there was still 100% chance you're going to blow your account. This is why so many traders are on this side of the quadrant, because you can actually see that it's very easy for you to have a tough month or a tough year, and then 20% of your trades are right and you're doing a 3-to-1 and you still blow your account. Or you get 25% chance right, there's a 5% variation here, and there's over 51% chance you're going to blow your account, right? And you can see it gets even worse at 4-to-1. You can see that 20%, 4-to-1, there's a 60% chance you blow your account. So let's just put a line through this, right? This is insane. So whilst a lot of people could pretty much achieve consistency and never blow an account by just simply achieving a coin toss, 50% of your trades being correct, 2-to-1, 3-to-1, 4-to-1, at any of these parts of the quadrant, you don't blow your account. But then there's still that small chance that you could just achieve a 1-to-1, right? So this starts to push people to the place where they have to be extremely disciplined, right? Because even if they're tossing a coin, 50% is quite easy to achieve. I think a lot of people might end up with a 45% as opposed to a 50 dead on, right? But then again, they might be doing 3-to-1, 2-to-1. This is pretty decent, right? You're going to make money if you're doing it this way, which is why there's a 0% chance of ruin. So what I try to do is try and bring myself into the 65-70% trades. That's when we talk about those grade A trades, right? High probability setups, because that means my win ratio goes up to about 65-70%. On my equity positions, I think to date I have about 65. I think it's about 69. I'll have a look at this again. I did look at this a couple of days ago, but I think it's somewhere between 65 and 70% of my trades are right? And good periods, we're looking at more close to 75-80%. But it's the kind of assets I trade and the things I do. So I look for those high probability setups. Also, I'm not looking for a payoff beyond sort of 1-to-1, 2-to-1. And if you crunch the maths, you start to see that there's a lot of similarity between low win ratio, high risk to reward in terms of net P&L versus high probability. But what high probability does is it balances the risk on your portfolio. So if I'm getting more trades right over subsequent occurrences, right? So let's say I get 6 trades right in a row, then I'm banking equity, which kind of offsets the trades that I'm going to lose on, right? And it's unlikely I'm going to lose in a row, like maybe 20 times in a row, because I'm looking for grade A setups, right? So I'm not over trading. So this side of the quadrant is the best place to be. Right now, of course, if you can do this and get to this side, but that, like I said to you, this is the impossible side. So really the optimal place you want to be is the bottom left of the quadrant, obviously facing you, right? So guys, I hope this made sense, right? Because I wanted to put a cam on this, right? I'm tired of people saying that, I made a 200x today, and it's just ridiculous. The whole notion is stupid. The fact that you could be at the bottom right of the quadrant and you're just a regular guy on social media tweeting this everywhere is just stupid. But you know what? People do it, right? But where you're likely to be is this side. So you're going to get a high number of trades right, but you're going to be getting out those trades like that quickly, like 1-to-1, taking your profits, 2-to-1 at most, in my opinion. you tend to see a lot of, if you're in the equity markets, you can easily achieve the 3 to 1. So you're going to be round about the middle, but you're probably going to sit this side of the coin. So you're going to be dead in the middle. The chances you're going to flow into this region are really slim. Some trades will push you here, but when you average it out, you're going to be somewhere between here to the bottom right of the quadrant. So that's your focus. If you can get it here, then you are a solid trader. You're going to have consistency long term. And that's what I'm going to try and do for you through this program, is try and get you here, right? That's the idea, is to give you all the tactics, all the good ideas to put you here. You know, if you're really good and you can improve yourself, then you might end up in the middle of the quadrant, right? You know, you have a bad year, whatever, you might float to the top middle of the quadrant, or at some point you might hold round about here. What we don't want to do is slip into this side of the quadrant, right, where there's a 100% chance. We don't want to be a coin toss on these things. And to push yourself out of a coin toss, you need to have good grade A setups, and you really need to know what you're looking for, and you need to trade assets that have a lot of volatility. And it's going to come into the reasons why I think equities are more superior to trade in order to arrive at this objective. Forex a lot harder. Most people in Forex are going to be floating around about here in a long enough timeline, or a best case scenario, they're going to be sort of the top center, right? So it's a hit and miss. Commodity traders are going to probably float a little bit more to the coin toss, the middle. So these guys will obviously pose themselves as the most successful, because a lot of them are going to be centering here, right? And then we've got a lot of those on, you know, come through on the exchanges, and they had different edges that are going to put themselves just where I'm trying to get you. So you're going to find that commodity traders are always going to say they're more successful than Forex traders, right? And obviously you see this with some of the index futures as well, where a lot more people are flowing into those because they can get more high probability setups, because indices are highly correlated to the equity markets. So you start to see the behavior change with traders, right? So you tend to find that most people want to be in the futures market, or they want to be in the equity markets. I think the equity markets give you the best chance to be successful, followed by the futures markets, and then the Forex markets, okay? And then we'll talk also about option derivatives and how we approach that, which have also a high chance to put you in this side of the quadrant, providing you know what you're doing with them. All right, so we'll take a brief coffee break, and we'll certainly come back to this. And meanwhile, just reflect, guys, on what we spoke about. Okay, so hopefully you enjoyed your coffee break. For those of you who did a coffee break, and for those of you who decided to go back and review what we discussed, I hope it's all made sense. All right, so moving on. The other bit that I felt was important to discuss was what we would call asymmetric risk profiling. Right, so this is going to be in line with allocating risk, right? So I'm going to basically show you guys how we think about allocating risk. So how do we decide to get into a risk-based position? There are a couple of ways you can look at this. So we're going to start with asymmetric risk profiling. So this tends to be used in markets that have leverage. We already discussed that. So most people will go for asymmetric risk profiling, which means that you're looking to achieve at least a 2 to 1 on your trade, you know, upwards, right? Again, most people over leverage, and that increases their need for asymmetric risk profiling, because with over leverage, they're going to lose more trades for sure, right? So as a consequence, because they're going to have back-to-back losses, a lot of unnecessary losses, they're forced into a position where their asymmetric risk profile has to be so big to offset that. And obviously, having looked at the probability of ruin matrix, we can clearly see why that's not going to work, right? Because there's just a high chance that you're going to end up in the top left of the quadrant, right? Even though you're aiming to be in the bottom left of the quadrant, you're still at the top left. And worst case scenario, you could push slightly towards the center, so the top center of the quadrant, right? Again, if you don't remember how the layout is in the quadrant, just skip back on the video and just relook at that quadrant again. And that's what asymmetric risk profiling will do to you in leverage markets. But it's not going to stop people still trying to allocate with asymmetric risk profiling in view. Everyone needs to, hence at the initial stage of this program, we said, well, we need to be able to make more money than we lose. That's the bottom line, right? So whether we go towards asymmetric risk profiling, where we're looking to achieve at least a 2-to-1, but we also have to think about the probability of that trade, and we're going to come to that. And then we have symmetric risk profiling. This tends to be more commonly used by investors who want to increase the probability of success of an investment, right? So by that, we mean we start to go down the routes of 1-to-1, for example. You hear a lot of people, in fact, I listened to a podcast with a apparent, I'm not going to say successful because I genuinely don't know, but it was a really big podcast, and this guy's claiming to be successful, right? So he basically says that in his proprietary trading firm, not the kind that exists now, back in the old days, his prop shop where he was with other traders in Modo, he says that he used to even aim for 0.9 risk, right? So his risk to reward was, I'm going to risk 1 to get 0.9, right? So it's basically, it wasn't even quite, he's going completely the inverse of asymmetric, right? So again, you're going to find people aiming for just 1-to-1, but that means they're taking trades with very high probabilities of success. So we're talking 80-90% chance that these trades are going to work out. This is where you're kind of aiming to be, right? Not necessarily saying that you should be aiming for 1-to-1 as a symmetric risk profile. What I'm saying is that even if you're asymmetric, you want 2-to-1, but you still want to increase the probability of the trade being successful. So the heart of risk allocation has to be, how probable is this trade that it's going to work out? So it means that you have to do a lot of legwork on the position. And that's why I gave you the initial technical template for trading stocks. And I was very clear on how you enter a position and why you go about it that way. So again, if you want to learn a little bit more about the liquidity side of things, so how the market behaves, so how those algorithms that make markets behave, then go back a few lessons and you're going to find that. But we're going to talk a lot more as well about how we deal with this in Forex. Primarily here we're discussing stocks. And some of this will flow into Forex and commodities and so on, but for now let's think about yourself as a stock investor. The other aspect is deleveraging. So eliminating leverage reduces risk significantly. So I mean, again, if we take the housing example, if you put down a 60% deposit for a house, then the risk of default or the risk of you losing that house is actually very, very low, right? Because you've paid most of the capital and interest towards that home. So being able to deleverage is important, because when you deleverage, it means that you give your trade a better chance to work, right? And what do I mean by deleveraging? So let's say you have, for every dollar you deposit, you can get $400. How about for every dollar you deposit, you decide, on $2, right? So that means that your leverage is really, 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 really low, right? So if you get to the stage where your leverage ratios are like 1:2, 1:4, 1:5, 1:10, then you're seriously deleveraging against an industry, let's say, for example, Forex, that has huge leverage. In the stock market, it's not that big. You're looking at, most of the time, it's 1:4, for example, right? So for every dollar you deposit, you can get $4. So it's not, and for the CFD stocks, it's 1:20, right? So for every dollar you get 20. So that's a big contrast if you compare it to, say, Forex, where it's 1:100, for example, in offshore brokers, or 1:30 in regular. So it's obviously in regulated EU brokers. So it is obviously proven that the lower the leverage, the less chances you're going to be exposed to risk. But obviously that's no fun. I understand this. And, if you're a Forex trader, it's no fun, because, we also looked at that at the beginning of this course, is how far certain assets go, or how far they can travel. And if you look, Forex has one of the lowest volatilities of all the assets. So obviously you need leverage. And if, you can't get a lot of money to borrow to take 10 standard lots or 100 standard lots, then there goes the dream of being a millionaire Forex trader. So you can get where I'm coming from, is that you effectively can't trade or, grow the dream if you're not highly strung. And obviously Forex markets do encourage that leverage. So again, this is just another example of the kind of markets you'd want to look into, right? Because again, like I said, deleveraging would reduce your risk. And when you're allocating, you think about that a lot more. And then we have the element of diversification of risk. So this kind of allocation is more common, of course, in the stock market, where it's possible to have non-correlation more than, say, currencies and commodities. And what do I mean by non-correlation? So let's say, like, for example, in my portfolio, I've got a semiconductor play that hardly anyone knows about, right? And that's a company that I researched and I bought. So the other day, the S&P 500 was tanking and my stock was going up, right? The correlation between it and the S&P 500 is very low. And that means the correlation between it and Apple and some of the other bigger companies is going to be a lot low. So that, in my opinion, is non-correlated to the rest of those asset classes, right? Now, if you take, for example, a currency market, let's say euro dollar, cable, these guys have at least a 60 to 70% correlation. Some assets have a near 90% correlation, right? And that's because in currencies, everything's trading against the dollar, and that's just how it is, right? The dollar dominates. It's 4.8 trillion of the currency market in terms of daily turnover is US dollars, right? And so because of that, we're going to expect that the currency is going to be highly correlated. So diversifying on a currency portfolio is nothing short of freaking murder, right? Because again, you have to be really good at doing it. It is possible for you to kind of play on, slight inefficiencies, right? So there's ways to do that, and we'll look at that when we do Forex. But again, it's not the dominant strategy. Ideally, as a currency trader, you probably just want to pick one currency pair, or at least maybe a group of currency pairs with the same base. So for example, GBP, JPY, GBP USD, GBP CAD, and these all have the same base. And there are times when you're going to notice, for example, that one or two of these currencies are weak against your base currency. So maybe looking at a basket of currencies that have the same base might be a good idea. But outside of that, it's going to be very difficult for you to diversify in currencies. Commodities is equally the same. They're all against the dollar. So again, they're not really any obscure commodities. We use this stuff in our day to day. So for example, corn is not really obscure. I mean, I've traded corn, I've traded wheat, soy oil, soybean. Like, these things are not obscure. They're part of food chain. So there's a lot of money in them. And also they're highly correlated to the dollar because of the impact of inflation. Usually inflation is from a rise in the price of goods and services. Well, that's the economic division, really, the modern economist definition, but really what it is a debasement of the currency. So if the dollar is debased, then producers, who obviously have to get a lot of their raw material production factors using US dollars, are going to find themselves that they can effectively do that. So they're going to increase the price of the commodity in order to cater for that. So commodities are very responsive to currency debasement, right? Which effectively is what inflation is. It's inflating of the money supply, right? So inflation is essentially debasement or increasing of the money supply, which eventually would mean that devaluation is going to impact the price of goods and services. So it's not, it was wrong of me to use the school definition of inflation, which is a rise in price, which it is not. It is a debasement of the currency, which eventually leads to an appreciation in price just because the currency is worth less. So hopefully that was just a quick lesson there in economics for you guys who are also quite keen economists. But in any case, I just wanted us to hammer that point home. So again, to recap, allocating risk, asymmetric risk profiling, symmetric risk profiling, deleveraging, and diversification of risk. These are the 4 components we want to put in our purview when we start thinking about allocating risk. Are we deleveraged? Are we on asymmetric or symmetrical? And this will highly depend on the market you're investing in or trading. And are we diversifying our risk? Again, this is dependent on the market we're trading. But again, all of these tend to reduce your risk, or at least help your risk allocation. Okay, let's talk a little bit about correlation risk. So again, we touched on that when we spoke about diversification, but I think it's important that I show you guys how bad this can be. So here we've got, as our main candlestick chart, is corn futures, Chicago Board of Trade, 1 month corn futures. You can clearly see that this is ZS soybean, and then you can see ZW, which is the contract code for wheat on the Chicago Board of Trade. Right, so we got wheat, soy, and corn. Look at the correlation, guys. Well, of course, because these things tend to be grown in the same land. In some cases, they're rotated in and out. So the price of these things are going to be very similar. But that's what I mean is that when we start thinking about correlation risk, do I want to be, for example, long corn and short soybean? That's a hedge, right? You might get a bit more volatility, but it feels like you're on some kind of volatility play, right? But then it's not going to be profitable for you. You're better off just going long corn and maybe forget about wheat, right? Because you're going to get the same thing. Or you might go long, say, wheat if you feel that you're going to get more of a volatile move to the upside. But in reality, as you can see, they're highly correlated. So what you don't want to do is basically be in the opposite side of this. Like, only rare circumstances are we going to see divergences between these guys. For the most part, that divergence will be rather short term. And if you've got like a complex strategy for, capturing short term, change or divergence, then great. But most investors don't have that level of complexity. They don't have the systems to be able to program to do that efficiently. And to be honest, the edge in that kind of trading is gone, right? There was a time, it's not here anymore. I mean, the algos are competing for this kind of stuff. So you can clearly see, again, just going back to historical lessons when we talk about liquidity, you can see it's no different even on the longer time frames on commodity markets, where we look for more that cyclical type effect where we want to get a bias. You can still see that once we traded above the liquidity, we came back down very sharp. We traded liquidity here and eventually traded the lows, and it just, as you can see, it just feels like a big circle over cycles. 2008, 2011, 2013, back down again, stayed down for a little bit, a few liquidity hunts, and then boom, big move, came down, final move down. Right, so again, where are we expecting this to go in the future? Well, it's not really rocket science, is it? Well, we need to come back down again, trade liquidity, and so we're going to probably do this over time. So you can actually see that it's really, with some of these commodities, if you're just smart and you know what you're doing, it's not very difficult to make money from the commodities, right? Which might be a different scenario when we look at some other asset classes. But again, correlation risk, guys. We don't want to be in a correlated position across multiple assets. Again, we've taken Forex as another example of correlation risk. You can see here that I've got Australian dollar futures on the CME. I've also got, where are we? I believe this is Euro, and I think 6.8 is the British pound, right? So as you can see, these are the different positions, right? So we've got the Australian futures, the pound futures, and the Euro futures, right? And as you can see, all of these are pretty much trading the same, right? So you can see that the correlation risk is really high. So if you're going to be long the Aussie, you might as well be long the Euro and long the pound. It makes no sense for you to be on the opposite side of that trade. For a little while, currencies like the Brazilian real, for example, they used to trade differently because those used to trade a lot more closer to the coffee and some of the other commodities. There was a high correlation. Anyway, you don't see that with a lot of currency brokers giving you the Brazilian real to trade, right? Because things that are not necessarily correlated makes it difficult for them to be on the opposite side of your trade. So anything that's unpredictable, that their complex algorithmic engines can't predict, so they know how you're going to lose money and when, they tend not to want to have, because the risk is too high, that because these things have very little correlation to the overall market, they can't make accurate predictions around monitoring their own risk, and it exposes them to, obscene risk. A good example, and again, if you don't believe me, for those of you who would be like, oh, I worked for a broker, or I did this, and I was a liquidity provider, I was a market maker, it's all bullshit, blah, blah, blah. So for all of you guys who are going to say this, I'm simply going to say to you, well, just think back to 2008, right? So for people who are listening who are going to be probably around such individuals, speak confidently when you tell this to others, right? Don't be afraid to tell them, because anything they come back with, I can guarantee you they don't know what they're talking about. In 2008 is a really good example of that, when certain banks got involved in collateralized debt obligations, which were really new products that were created for the purpose of presumably scamming stupid investors, right? Sadly, it didn't go that way. Those investors weren't stupid. They were highly sophisticated. A lot of them were retail, that they weren't even allowed to participate in this product. I think one of the guys was told they need to come up with 30 million just to get a seat at the table, right? So there was all of that particular stuff going on, right? So yeah, this is just another thing that we need to put in our purview, basically. Okay, so we all understand, hopefully, correlation risk. This is not something that should be confusing us anymore. All right, let's talk about proof. I love this part, right? So we're going to talk about the proof. All right, so first and foremost, let's think about asymmetric risk profiling. It looks a lot like this, and I've taken, so this is the green, right? This is potential profit, and this is potential loss. This is typically what most traders will set up as a potential play. Now, obviously, as you can see, the only reason why you'd set up asymmetric risk profiling is if, in other words, you were using leverage. Because why would, if you could pretty much buy, let's say, 1,000 shares of Coinbase, you're not going to put a stop loss against that, right? Because obviously it's 1,000 shares, you can hold it. And obviously if Coinbase doubles, so you'd have pretty much $72,000 gain in a couple of days, right? Which is what happened to a lot of these assets, or in a couple of weeks at the very least. I mean, if you think about the low of Coinbase, that was in June, and you're making more than most people make in a year in the space of 4 to 5 months, right? And all you needed to be able to do that is 72 grand or 70 grand. On the flip side, unless you hit your head at some point in life and something's not working correctly, you're not going to make the assumption that Coinbase is going to go to zero. I mean, yeah, if you look to the company and you see the time, you're just not going to do that. Nobody does that. So from my point of view, it makes sense to deleverage into this, right? So commit more capital and go. But again, let's make the assumption you don't have a lot of money and you really want to be able to pull this into some massive gains. Then you're probably going to do an asymmetric risk profiling. And obviously, if you follow my method of entry, then that would have given you a good chance of a 3-to-1 on this asset. In fact, if you held it, it would have given you much more of a gain. But you'd have to be sure you're looking at the absolute bottom, right? And for a lot of people, that's what they're not sure of. They're not sure if they've got into the trade. There's a lot of nerves associated with the trade, so they're not really sure if they've entered the trade at a reasonable place, or are they going to get stopped out. Now, potentially, let's say, I think this is a 6-point stop. So let's say this was a $600 sacrifice. You can see that it was worth it from an asymmetric point of view if you were right and it went up. And if you're wrong, you'd lose $600. So as you can see, when we use asymmetric risk profiling, we do increase our risk for sure of losing a cash sum, as opposed to, say, deleveraging as an allocation strategy, right? So again, if we allocate with asymmetric risk profiling, we're doing that more than likely because we don't want to lose too much money because we're leveraged, right? And that means that, let's say, for example, you had 100 shares, that will be the equivalent of just having just over 7,224, and you're risking 6 points of that. Then effectively, yeah, that's $600. That's a $600 loss if this goes sideways. Now, because of the volatility, it could easily go sideways. So it could have easily stopped you out, nonetheless hunted liquidity again and then gone. So hopefully at this point, a penny is dropping and you should all be saying to yourselves, I get it. That is why they're liquidity hunts, because what would be down here? Yes, I know you know it. They're going to be, if you're long, they're going to be sell stops, right? And those sell stops, when they get triggered, will be selling to someone else who's a buyer. And so they can come and take out your sell stops and take your 100 shares from you at a much cheaper price and then run it up. So who do you think are going to be the most victim to this kind of behavior? It's going to be leveraged people. And that is why the market promotes leverage, is because they can essentially lend you money so that they can get more of your deposit. That's it. It's really simple. So if you know that already, you can just deleverage on the trade or essentially allocate that way. Just be aware that there's a higher probability you can lose if you have a kind of stop like this in the equity market. So that's another example there of asymmetric risk profiling and how that could impact your risk methods. Now let's look at another scenario. So here's typical symmetric risk profiling. So you extend that risk a little bit more outside of the volatility of that asset. What do I mean by that? Now, most assets have an implied volatility, how far they can go up or down relative, right? So it comes into the point you need to know your asset. So if you know your asset very well, then you would know that, okay, if Coinbase is dipping, it's probably not going to have a big cataclysmic drop, right? Because obviously we're trading out liquidity. It's very possible we're going to go up. So you might opt to say, well, just in case they come and hunt liquidity, they're not going to hunt it too far. So I'm going to increase my risk a little bit more, right? So I'm going to make it a 1-to-1 as opposed to asymmetric, right? I'm going to make it more symmetrical. And if I'm going to do that, that effectively means that I'm giving myself higher probability that that trade works out. Now, in this example, the asymmetric guy would have felt like a genius, right? So I got a 5-to-1 trade, I got a 10-to-1 trade, but that's hypothetical risk because you were nowhere near. I mean, we didn't actually trade there, so that's all you would have lost, yes, but you would have still also missed out on the opportunity if that market had liquidity hunted you and ran. Now we have obviously the symmetrical guy who would never fall in victim to that, so that increases the probability of in that scenario that this trade would have worked out. So we have now accounted for liquidity hunting. So symmetrical risk profiling also has its purpose, but in this scenario both people would have won. Just one allocation strategy had a higher probability of success based on the historical volatility and behavior of Coinbase as an asset. So that's an example of symmetrical risk. And if we look at the numbers, you'd have to reduce the maybe the amount of shares you buy in order to reduce the dollar risk on the position. So there are a lot of things you could do in order to accommodate a 1-to-1, right? But again, that's why a 1-to-1 strategy pushes you much quicker into the other side of the quadrant. So if you were employing this, for example, in like say Forex or some other asset that is not as volatile as stocks, you might not find this a very beneficial strategy, for example, to allocate risk. So a lot of people do move away from symmetrical, but guys who might trade the equity markets or markets where their volatility is a little bit more predictable on the short term and the long term, they might appreciate symmetrical risk. Also, let's take a look at another example of deleveraging, right? So again, here we're looking at a scenario where we don't care if the stock goes down. So let's say we have $7,000 and that's pretty much what we're happy to put in. Well, in a couple of, where are we? So let's say you were in this position on the bounce or the liquidity hunt. That takes us back to pre-October this year. We're in December, in October, November, December, not even quite December. Coinbase was well in the $120 mark. Today, I think as of doing this, it was trading very, very high. I think it was 130, 134 was the high, right? So you would have made an additional $6,000 in the space of 2 months. Hence why the conversation we've been having about stock market, forex markets, correlations, and non-correlating assets. For all these conversations are geared towards giving you the best information to decide what you want to trade and to follow opportunity. There's so many people who trade for trade's sake. Like, they get into investment for investment's sake. Oh, there's a guy on Instagram who's trading Forex and he's making $1 million. I should trade Forex. Oh, there's a guy on Robinhood who's making trading options. Stock, I'm going to trade stock. They're not really thinking about where's the opportunity. The opportunity was in a single stock called Coinbase, right? That has been one. This has been a stellar, but it's not been the only opportunity. There have been other stocks that have done multiple X's. A couple of months ago, I bought a stock called Danaher, right? That did multiple moves, right? But again, because if you're completely deleveraged, you're not looking at it that way. You're thinking about it more like it's capital gain on a portfolio, and it's because I have a little bit more capital, for example, so I can allocate it with a little bit more confidence. I don't need to over leverage. Right now, of course, if you want to employ leverage again, then good luck. But this again is what we call deleveraging, wherein the downside, we don't care because we're not borrowed money. It's our own capital. And what are the chances Coinbase goes to zero, right? If Coinbase drops, we can even do what we call a dollar cost average. Even if it drops further, we can also look at that point at what is it chasing? Is it about to trade into, somewhere with the extreme float rotation? What is going on here? Is there an opportunity to come in and buy it at a cheaper price and then thus create a more profitable average? So what do I mean? You could have bought Coinbase at $72 and then you paid $50. If you add the two together, that's 120. You divide it by 2, that works out to be 60. So your average is $60 because you bought at 50 and you bought at 70. Your average cost is 60, for example. Right, this is a simple calculation, right? Other things get factored in, cost, etc. But your average price becomes 60, right? So again, in a deleveraged scenario, and this is based on the fact that you obviously bought, I'm just done the example based on the fact you bought one share each, right? So if that stock goes to say 120, then you make a $60 profit, right? So these things you can do in a deleveraged position, right? And also having a bit more capital. And even if you don't have a lot, I mean, literally we're talking about under 10 grand. So usually I would say to an investor, if you're going to trade, you're going to invest in a company, you got under 10 grand, then look for companies that move a lot. So it's going to expose your your 7K to a bit of volatility, but it gives you an opportunity to be able to make quick gains without overexposing yourself with leverage, for example. So these are some of the benefits you get with the stock market, which is volatility. You get a lot of it. And because of that, you can profit a great deal. Okay, I hope this has been informative, right? It's been a long session, but I intend it to be this way because I want the people who stick with this, I want them to be winners, right? I want them to go out and say, I did that free professional trader program on YouTube by Greedy Trader, and now I'm a great trader. I want people to say that. So I've deliberately draw it out. I talk a lot to narrow people's attention span. We live in a world with short attention spans, so people can't handle other people talking. It's just too much. They want to switch off. They want a quick fix. They want that guy on TikTok going, blam, 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 put this there, put this there, put this there, boom, 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 and now you make money. They think it's that simple. But I'm hoping from all of what you guys have learned, coming from lesson 1 to now lesson 7, can you believe it? That you're starting to understand that that's not where you want to be. It looks attractive, right? The guy on the other end looks attractive, right? But, I listened to another so-called successful trader running millions of courses, driving a Lamborghini, out of his own mouth say, well, it only cost me $3,000 a month to drive a Lamborghini. I sell $50,000-$60,000 worth of courses every month. So what's $3,000 on a Lamborghini? And I can keep saying I'm a successful trader. Some by their own admission say, hey, I own my own brokerage, right? So I can trade against my own clients. I make money when my clients lose money. So I'm always a successful trader. I can manipulate the back end of the MT4 server reports so that it shows that I'm always profitable. And more people are going to be attracted to that on Instagram. A lot of people are not doing this course. They don't know. They haven't learned some of the stuff I've taught you. They don't even know what I'm saying now is possible. They don't know, but I can tell you. And I don't care what anyone tells you. This is what they do. This is possible, right? I've like I said, I know the back end of MT4, MT5. I've sat with Metaquotes and had a personal presentation on this, like how to work the back end. So I've been in privileged positions that most people have never been in this bit. So when I tell you that it can all be manipulated, so to make it look good, believe me, because that's the case. I've got no reason to lie to you. So in any case, we're at lesson 7, and a lot of people, like I said, they don't know what you know at this point, right? So it's easy for them to believe what's going on Instagram. It's easy for them to trust that guru, right? It's just so easy. But anyway, don't fall for the trap. So for those of you who are still here, homework, exercise 1, compare the different risk profiling and decide which one you will use and why. So I want you to think about all we've talked about: risk profiling, risk allocation, the matrix, and think about it against the asset you've been trading. What would you want to employ? Do you think that would be the best strategy? How do you want to think about the trade now? How would you want to enter into a trade? If you thought about, you should have done some of the other homework, but if you thought about what we've spoken about, we spoke about a lot. I hope you've digested this and thought, wow, that is absolutely true. I should be buying those levels. I should be selling those levels. Right? So I'm hoping that you guys are thinking on this, because trust me, you just go back and look at chart to chart, go back historically, and you will see everything that I'm saying to you right now is absolutely 100% correct. So go see for yourself. Don't just take my word for it blindly. Don't just say, oh, Greedy Trader has been on YouTube since 2014, so he must know what he's talking about. He's been a trader for 15 years. I've seen some of his exclusive programs, and they're a little bit more in depth on different topics on Udemy. So, he taught me order flow. I can see he's got level 2 systems. I can see, he makes money trading options on his Discord. So I don't want any of that, right? I just do what I do and I share. I don't want anybody to look at me in that way. I just simply want you to go and look for yourself, basically. As far as I'm concerned, I'm just doing what I'm doing because I know that's the way to do it. So I don't have any need to listen to what someone else is saying. I don't need to change what I'm doing. I'm just doing what I'm doing because I know that's what you need to do in order to get ahead. Someone else can do what they're doing. Someone else can say they make 200, 300% annually consistently. They can say that. For me, I don't really care. I just do what I'm doing, and I'm sharing that with you guys and hoping that you digest it and it really works for you. Anyway, guys, till the next lesson, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?